I'm Michael Monahan, Portfolio Manager at the Founders 100 ETF, FFF. You're watching Taking Stock.
Time to rock and roll. 2 minutes to go here into the closing bell on Wall Street. Oil moving higher, stocks moving lower, but also kind of moving higher here into the closing auction. All this coming after a hotter than expected CPI inflation print earlier this morning, and some news in the world of geopolitics. Investors somewhat shaking it off. Let's kick things off with the great Peter Tuchman. The Dow positive, the NYSE Composite Index positive. Look at the S&P though, trying to make a bit of a bid into the close.
I think they spent all day trying to shake it off. We hit a double bottom sort of midday between 11 and 2. We've been massive to buy all day long on the imbalances, over 2 billion all day. And so that just shows that, you know what, the market still is going to engage headlines a little bit, but at the end of the day, they're more interested in the upside potential of the market than the downside. People aren't really selling this market. It's a lack of sellers coming in and the buyers really getting, buying with intent. That's what today looks like to me. When you see it really, we were here for another minute or two, we'd be closing up.
So you see some conviction in the buy side.
Yeah, absolute conviction. We've seen that for the last 3 weeks. Right, and so 1 or 2 days are one-offs when it comes to the market pulling back. That was an oil play, but for this, it's definitely buying with conviction.
Yeah, we're just 1 day removed from another round of all-time highs. We'll see what tomorrow's tape is. The Einstein of Wall Street. Peter, kick us off. Thank you, Peter. Nice to see you as always. All right, time now from the close. AAR set to do the honors. That's how it's done, and the crowd goes wild down here on the trading floor of the New York Stock Exchange. Your final tail of the tape on this, Tuesday, May 12th, the S&P 500 in negative territory, 0.16%, not even 2/5 down. The Dow eking out a positive round of gains, though, up 1/10. The NYSE Composite Index also in the green, up 0.2. And the small caps down about 1% as well. Memory stocks and semis hardest hit on the day. Shares of Micron down 5, SanDisk down 7, Marvell and Intel down 4 and 7% there respectively. Software stocks also mostly lower on the day, though names like MongoDB in positive territory. Handful of retail names actually doing pretty well for today's tape, not to be forgotten here. Target, Costco, and TJX. Yields all up across the board. The biggest move happening with the 5-year Treasury. That putting downward pressure on the major home builders. Let's talk with Phil Rosen now, longtime friend of the show, chief market strategist at ProCap Financial. My man, thank you for being here today.
Thank you, JD.
As we look, so if you and I were here this time yesterday, we'd be saying, wow, another round of all-time highs. Sell side a little bit louder for the S&P 500, but we're still basically at these all-time highs. What are a few of the things that you're following, you're seeing investors contend with day to day?
I mean, the whole story is earnings, right? Earnings continue to be revised higher for the year, and earnings have come in extremely well through the first quarter. And if you look at tech stocks and tech earnings, stocks are actually cheaper today than they were 4 or 5 months ago because earnings have been so good and they've crushed expectations so bad. So that continues to be the jet fuel for markets. We had a bit of a pullback today, a little bit of slower momentum, but to me, there's nothing right now that says, okay, it's time to really start to get cautious.
Speaking of jet fuel, though, investors shaking off another round of geopolitical concerns. This type of things in the first and second week of March with regards to the conflict in Iran, including jet fuel and diesel prices, that caused stocks to really pull back. Investors saying, yeah, we've kind of seen this play out before. Let's focus on earnings instead.
So I looked at the inflation report this morning, 3.8% year over year. That's a little higher than we expected. But all the investors I've been speaking with, and also my personal view, is that AI is the new macro. We're not going to look at the 0.1% differences on inflation reports and have that change our view on what AI really means, what it's going to do, what the promise of the technology is. So to me, AI is the macro. That's why investors have been able to shrug off pretty much every CPI report, all the Fed updates, all the updates in the Middle East and the Iran conflict. None of that has really derailed the bull market, and I don't see how anything in that calculus is going to change.
We're still a few weeks out from NVIDIA earnings, but I wonder how you think about that. We know out of the Mag 7, NVDA tends to be the final of those Mag 7 7 earnings reports. We're through most of them, and we're not necessarily going to talk about it this week or next, but when we get closer to that earnings date, I feel like it's going to be all eyes once again on what happens with NVIDIA.
It's pretty much hit or miss on whether NVIDIA goes up or down on earnings, but it's almost guaranteed that they destroy earnings. Like, they are going to crush it. They've been crushing it for several years now, and I would never want to be on the other side of the trade betting against NVIDIA doing well on earnings. And I know there's a lot of people coming out that are calling the top in the AI trade. They're saying it's a bubble. They're saying it's another .com. I think that's all bogus. NVIDIA is going to prove that once again this quarter, that we have plenty of demand still left in this cycle. NVIDIA, it's so consistently good, it's not even on my radar right now.
All right, Phil Rosen, Chief Market Strategist at ProCap Financial, one of our very good friends here on Taking Stock. My man, come back anytime.
Thank you, thank you.
Good to see you, Skylar. Grab your mic. Howard, you and I will head this way. We're bringing the biggest analyst calls on this morning's tape. First up, Citi analysts upgrading Lowe's to a buy from a neutral rating, saying it's bullish on the hardware giant ahead of their earnings, which are also May 20th, like the aforementioned NVIDIA. Shares of Lowe's are down 6% since the start of 2026. Also, Deutsche Bank reiterating Intel as a whole this morning. They say the foundry business is fast gaining consumer traction. Shares of Intel up 90% over the last month alone. Finally, Susquehanna reiterating NVIDIA with a price target of $275 a share. They're expecting better results and guidance for earnings later this month. Shares of NVIDIA up about 14% from the start of this calendar year. Howard, let's take a look at one New York Stock Exchange notable company. This is, of course, shares of Nike down 0.09%. It reached a fresh low on the day of $42.06. Some important context, split adjusted, this is the lowest that Nike shares have been going all the way back to October 16th, 2014. For a bit of perspective, the #1 song on the Billboard Hot 100 chart on that date was Meghan Trainor's All About That Bass. So clearly it's been a while. It's been quite the ride for Nike. Shares are down 34% on the year amid the company's ongoing turnaround strategy. Last week at Consensus 2026 down in Miami, Florida, FinTech TV lead anchor Remy Blair sat down with former acting CFTC chair and current MoonPay head of institutional Caroline Pham. Take a look.
Welcome to FinTech TV live from Consensus Miami. Now, MoonPay is moving beyond just being a crypto on-ramp and a massive push to dominate market infrastructure on 2 strategic acquisitions. Now, D-Flow2 powers Solana trading, an Israeli security startup Sodot to secure institutional assets. Well, here to discuss this expansion is Caroline Pham, who is Chief Legal Officer and Chief Admin Officer at MoonPay. Caroline, great to have you here. Thank you so much for joining me.
Thank you so much for having me on the show. It's exciting to be here. And I've now added another title, which is Head of MoonPay Institutional.
Yes, so I do want to ask you about that. You are wearing 3 executive hats here, and you're on the ground in Miami. We're here the final day of Consensus 2026. So tell us about your experience now that you have assumed all of these roles.
Thank you so much. Well, it's been so exciting to join MoonPay. I mean, really what drew me to MoonPay was the vision of our founder and CEO, Ivan Soto-Wright, and Keith Grossman, our president, but really looking at how MoonPay should be the operating system for value. And when you think about the operating system for value, it's really about how do you interact with your money? Your money should work for you. Your money should be available for you when you want it, how you want it, and you should be able to talk to it. You should be able to converse with it. You should be able to use a chat box, just like you can use with a Google search, with your AI chatbot, with your Gen AI. And so with MoonPay agents, when we've really unleashed agentic payments, really opening the door for agentic commerce, it's just the first building block in having an operating system for value, where you can type in what it is that you want to do in natural language and have your agents handle that for you. So if you want to set up a recurring bill pay, if you want to plan a kid's birthday party, set a budget, set limits, if you want to do your own agentic trading bot, all of these things are really possible with the approach that MoonPay takes to an operating system for value. And when I saw this amazing technology that MoonPay has and how it's scaled, and it's been proven to operate at scale. So if you think about MoonPay, it's 30 million users, 180 countries, being able to settle in 120 fiat currencies. To me, I thought institutions would love to be able to have this capability. You get blockchain in a box with white label technology infrastructure And so it's been proven at scale, it's secure, it's resilient. You mentioned our acquisitions, 100 million all stock deal for Sodot, which is an Israeli defense technology firm that does secure wallet infrastructure, founded by Ido Sofer. And then DFlow, founded by Nitesh. And DFlow is the execution layer for Solana. I think it powers maybe over 65% of Coinbase's volume on Solana. So this is really about owning the entire tech stack end to end at scale. And most importantly, and this is something I say in Washington all the time, you can have KYC AML with DeFi. A lot of people say that's against the ethos of DeFi. They say that that's not what DeFi is about, but that just doesn't make sense. DeFi is about having access to markets. It's about making any chain, any token, any wallet available to anyone. That's what our technology enables, and we do it with KYC AML.
And you've given us such a great overview of what's happening over at MoonPay. And I'm so glad to have you on the show now that you are at the organization. And here we are at Consensus, and not only are traditional finance as well as builders, innovators, policymakers are here, but you have a unique perspective because not only do you have experience being on the nation's capital at Capitol Hill, but also working in traditional finance. And
Yes.
now that you are at MoonPay, tell us what you think needs to happen as we head into the rest of 2026, especially when it comes to regulation.
Sure. So I think that right now we have sort of two more macro trends that are colliding, for lack of a better word. And so, first of all, you do see that I've always had this thesis that we were going to see a move towards a more open architecture for payments and financial market infrastructure. That's very consistent with the trend towards open banking, which started with the fintech revolution in the 90s. So with a move towards more open payments and market financial infrastructure, that means that you're going to see convergence between TradFi and DeFi, which is all about what we're trying to enable, blockchain in a box, for anybody who's facing that question of, do you need to build or do you buy? Building takes years. People have been building on blockchain. Institutions have been building on blockchain since 2018. You know, we're looking at almost 10 years. But now boards and investors are saying, what's your digital asset strategy? And you don't have 10 years to develop those in-house capabilities. So I think that's really key. So that's one sort of macro trend, that, and then that convergence of TradFi to DeFi. So what is the role of regulation in all of that? So part of what I had announced last year with my crypto sprint at the CFTC, you know, obviously we launched for the first ever spot crypto trading on financial exchanges that are registered with the CFTC. We also had the tokenized collateral and stablecoins guidance, and the digital asset markets pilot, which was really important to have, like, Bitcoin being used for collateral. The part that we didn't get a chance to finish, though, and which I really think needs to be focused on now, is we need to make sure that blockchain can be used as financial market infrastructure. So that means amending CFTC rules, SEC rules, making it clear that these regulations should be technology neutral and that it should be fine to use blockchain in order to power your trade matching engines, to be able to use them for your books and records, to be able to do your collateral operations using blockchain technology. It's not scary. It's not this, kind of, crazy revolution disruption, because if you think about it, it's not any different from when we went from paper to computers and now to blockchain, which is really just decentralized computing. So I think that's one thing that regulations need to focus on.
Caroline, well, great having you join us here at Consensus 2026 in Miami. I appreciate your time and your perspective.
Thank you. Thanks so much for having me.
Thank you.
Welcome back to the show, to the world of fintech, crypto, and artificial intelligence headlines. We now turn at this hour. The crypto majors are all down in negative territory, with Bitcoin reclaiming a little bit of a newly formed support system right around 80,000. Next up, OpenAI set to buy consulting firm tomorrow and also launch a new PE-backed joint venture aimed at helping more businesses adopt artificial intelligence, with investors contributing more than $4 billion. And finally, South Korean officials raising the idea of a so-called citizen dividend funded by AI-driven tax revenue, as growing profits at chip giants spark renewed debate over who should benefit from the global artificial intelligence boom. Earlier today, FinTech TV's lead anchor, Remy Blair, sat down with Evgeny Gokberg of RE7. They discussed DeFi yield and much more. Take a look.
Let's take a live look at Capitol Hill as the crypto industry awaits a key markup on the Clarity Act in a little over 48 hours from now. Now, Coinbase CEO Brian Armstrong plans to meet with lawmakers over the bill tomorrow. He's been front and center in the stablecoin yield debate with banks. And along those lines, yields are a form of interest for DeFi users. Crypto firms want to pay them to stablecoin holders, and also users also earn them as rewards for staking their tokens like Ethereum or Solana. Well, joining me live here at the New York Stock Exchange this morning is Evgeny Gakberg, who is founder and managing partner of RE7 Capital, which is a research-driven digital asset investment firm. So great to have you here. Thank you so much for joining.
Here. Thank you.
So when it comes to DeFi yield, where does it actually come from today?
So DeFi is basically an ecosystem of fintech apps that exist in this blockchain world. And because they're isolated from the traditional banks and traditional liquidity providers, that role is outsourced to the market, to the individuals and professional firms who are doing this for a living. So the yields come from lending, market making, and all the other traditional functions that traditional liquidity providers and financial institutions perform. It's just that here is done very differently.
Yeah, and many of us talk about the maturity in the digital asset space, but give us your take on where we stand right now.
The industry went from zero to hundreds of billions of dollars of assets currently sitting within those apps. So what used to feel like a video game 6 years ago currently has billions of dollars sitting there in passive capital, as well as more than $1 trillion in trading volume over the last few years. So this has grown to be a very valid and very strong fintech sector.
Yeah, and speaking of which, I do want to get your take on what you believe will be the primary catalyst to unlock some growth and liquidity, especially at a time when we're keeping an eye on the Clarity Act and the progress in terms of the regulatory landscape. What are your expectations?
DeFi started as a fully isolated sandbox where random people were playing with random coins, trying to get some yield and trying to generate some capital gains. Right now, this world is converging with the world of traditional finance, where the real banks and the real asset managers are deploying their assets on the blockchain. They're tokenizing stocks and credit instruments on the blockchain, which means that DeFi is basically becoming the back-end infrastructure for traditional finance.
And heading into 2026, institutional adoption as well as tokenization, the rise of real world assets, those were the themes that we're all paying attention to. So when it comes to real world assets, what is your outlook?
It's growing exponentially, and there is no sign of it stopping. We've seen that as the Middle Eastern conflict progressed, there were traders actively trading oil on the weekend, which is a synthetic representation of that, because you can't wait for the market to open on Monday. We've seen exchanges announce that stocks will become 24/7 at some point in the future, and blockchain will play a big role in that. And credit instruments have grown like there is no tomorrow when it comes to their blockchain adoption.
And when we're talking about markets, you and I are here at the New York Stock Exchange, and traditionally we know that markets open at 9:30 and close at 4 p.m. But when we're talking about the weekends, for example, I think the Middle East conflict really highlighted how active traders are 24/7. So when it comes to this space, what is your outlook in terms of advancement, and what will that look like, not just for the institutional side, but also the retail side?
I think 24/7 is inevitable. It's very clear there is demand from people to trade beyond working hours. There's demand for people to trade on the weekend and use new types of instruments, whether these are synthetic oil derivatives on the blockchain, even prediction markets, to hedge some of the market scenarios. That's clearly a trend.
Yeah, so what does diversification look like in this space?
That's a great question. Diversification is very hard to achieve within the digital asset space because coins are traditionally very, very correlated. But now blockchain is more than just volatile crypto coins. It's traditional stocks, it's credit instruments, it's stable coins that you can use for payments and other things. And over time, that diversification and decorrelation is growing.
Well, we will have to leave it there since we are looking at the equity market about to open. Thank you so much for joining us.
Thank you for having me.
Thank you.
Welcome back to the show. Everyone talks about the artificial intelligence boom, but which layer of the AI ecosystem ultimately wins? Last week on the JD Durkin Show, I caught up with the great Kai Wu of Sparkline Capital to find out. Take a look. Let's start with the AI boom. Where are we really in the so-called value chain right now? The relationship between infrastructure, cloud compute, the foundation models. How do you approach this to make it make sense for someone watching?
Yeah, look, I'm a big AI bull. I was training my own LLMs in 2020. But I think the lesson as investors we should be very cautious about is that just because a technology is transformative doesn't mean that you'll make money investing in the companies. So it's very important to think about, first of all, timing, where are we in the cycle? And second of all, where in the value chain are you putting your money? The dot-com boom was a great example. You come in too late and you're down 90%, even if you are correctly forecasting the future of technology with the internet, of course. So where are we today with the build-out cycle? I'd say like a useful framework would be to, obviously you can segment the value chain in any number of ways. I think the most useful kind of simplistic way to do so is to have this, there's just two categories. There's infrastructure, which includes like the chips and the memory and the power and the data centers, even the model providers. So like Anthropic and OpenAI, and then the users, the adopters, which would include any enterprise or even consumer who's utilizing AI for their own means, whether it's to run their business more efficiently, to expand margins, et cetera. So I think that where we are in the cycle for those two categories is very different. We're obviously well underway with regards to the infrastructure build out. Companies are committing trillions of dollars now over the next few years in building out ever bigger data centers, and obviously the stocks of all the infrastructure companies, whether it's the hyperscalers, Micron, NVIDIA are up big, obviously.
Sure.
And then there's the adopters, the users, right? I think it's still early days. The USBLS does a survey, and 10% of businesses are using AI in production, which is a pretty low number.
Yeah.
And so I think that you think about the classical model of technological diffusion is this S curve, where you have like the innovators, early adopters, then the kind of like early majority, late majority, and then finally the laggards. We're still kind of at that inflection point of that S curve with regards to actual adoption, right? So that's the key question around, you're probably going to ask me, is AI a bubble, right? It's a timing question. We have, a lot of money committed up front to build out the underlying infrastructure, which we need to do, of course, for any situation like this. Yet the revenue, yet the adoption and usage is still, ramping up. So the question is there going to be a timing mismatch there, which could, of course, lead to some issues for these companies?
Is it too early to tell, or do you have a sense which layer of the AI ecosystem ultimately wins?
Yeah, it's an interesting question. Like if you go back to historical episodes, usually what you find is that the actual builders of infrastructure are not the long-term winners, right? The folks who built the railroads, hundreds of railroads companies were created in the 1800s. Basically, they all went bankrupt. You go back to the automobile. Like obviously Ford survived, but you index into a bunch of auto companies, not a great investment. The dot-com boom, all the telecom companies that raised all this money and took on debt to build out the fiber optic cables for the internet. Global Crossing failed. AT&T still around, was dead money for a long time. The telecom index went down 92% in the dot-com bust and never recovered, even as of today. Right, so that's the question, which is, who are the long-term winners in this situation? What we've seen historically is that the builders, ironically, don't end up, earning the spoils of their creation, while it's the users, the adopters, right, like Netflix, Google, Meta, that came out later, right, after the dot-com bust, and ultimately, won the internet era. So I think that's an interesting framework, not saying that that's necessarily going to be what happens today. History rhymes, doesn't repeat. But I think, given where stocks have moved, obviously infrastructure stocks in an AI space have skyrocketed with like much less, gains on the adopter side. I think it does, lead me at least as an investor to kind of pause for a second and think, where are we headed moving forward?
Welcome back. I'm Scarlett Sieber with Money 2020, and this is how fintech companies actually make money. Today's reminder, not all great fintechs want to be loud. Some just want to compound quietly for 30 years. Let's meet one. Meet Vestwell. Vestwell provides infrastructure for retirement and workplace savings, powering 401ks, IRAs, and employer plans behind the scenes. So how does Vestwell actually make money? First, asset-based fees. As assets grow, revenue grows alongside them. Second, platform fees paid by advisors and employers. Third, service and compliance revenue from onboarding, reporting, and plan administration. And fourth, time. Retirement dollars are incredibly sticky. So here's why investors love this model. Churn is low, regulatory barriers are high, and once assets land, they tend to stay put for decades. Momentum check. Vestwell's massive Series D in Q1 26 was a reminder that predictability still commands a premium in fintech, even if it's not flashy. So what is Vestwell's moat now? Inertia and trust. Employers don't change retirement platforms lightly. Employees expect stability. And that is exactly how Vestwell actually makes that money. Slowly, predictably, and at scale that doesn't show up on social media, but absolutely shows up in revenue. Turns out patience is still one of fintech's best business models. Not one of mine, I'll tell you that right now. Have a company that you want us to feature? Drop it in the comments below, and it just might make the cut. In the meantime, back over to you.
Welcome back to the show. The best performing sectors in the S&P 500 today: healthcare, consumer staples, as well as energy. Your S&P 500 laggards on the day: tech, discretionary, and industrials. Walmart, Coca-Cola, UNH, those are the Dow's big dogs on the day, and your Dow laggards: Salesforce, Caterpillar, and IBM. Tomorrow morning, April PPI plus the latest quarterly results from Alibaba, Wix.com, Cisco, and much more. Thanks for watching today's edition of Taking Stock. Have a good night. We'll see you again tomorrow.